to all of our listeners and viewers around the country and around the world. Lawmakers and public officials in California, Ohio, South Carolina, Missouri, Washington, and other states are attempting to crack down on the controversial practice known as payday lending. On Wednesday, the governor of Kentucky, Steve Beshear, signed into law a 10-year moratorium on new payday lenders in the state. Payday loans are short-term loans or cash advances secured by a post-dated check. The annual interest rate for these loans can be as high as 400%, 10 times the highest credit card rates. Consumers who renew their loans often end up paying more in fees than they had originally borrowed. Critics say the system is a form of predatory lending that traps the poor in a cycle of debt.
In the early 90s, there were fewer than 200 payday lending stores in the country. Today, it's a $40 billion industry with more than 22,000 stores. There are more payday lending stores than McDonald's and Starbucks combined. As more Americans are living paycheck to paycheck, the demand for payday loans is increasing. We're joined now by two guests who've been following this story. Journalist Daniel Brook joins us from Philadelphia. His article, Usury Country, Welcome to the Birthplace of Payday Lending, appears in the new issue of Harpers. He's also the author of the book, The Trap, Selling Out to Stay Afloat in Winner-Take-All America. And we're joined by Ginna Green of the Center for Responsible Lending. The group's releasing a report today that reveals payday lenders are significantly more concentrated in African-American and Latino neighborhoods in California than in white neighborhoods. Daniel Brook, let's begin with you in Philadelphia. A very interesting piece in Harper's. You begin in Johnson City, Tennessee, where I'm actually headed in the next few weeks. Talk about exactly what payday loans are.
A payday loan is a short-term, high-interest loan. Here's a typical transaction. Let's say you work at a fast food restaurant and you're going to get paid next Friday, but you've had an unexpected expense, say your car broke down, and you need money now. You would go to a payday lender, you'd write out a check for, say, $230, and they'd give you $200 in cash right then. The check, you know, would be bad, and it would be dated to your next payday. Then when your next payday rolls around, you're supposed to reappear at the payday lender and buy your check back in cash for the full $230 value. Now, on the face of it, it already sounds like a high-interest loan, but it's typically much worse than that, because the percentage of borrowers who, when their payday comes around, are able to pay it off is very small. I mean, even industry-sponsored research shows that only a quarter of borrowers are able to consistently pay off their payday loans when they come due at the end, at their first pay period. State research shows rates in the 70s or 80s, or close to 90% of borrowers can't pay these off. So it's clearly a debt trap.
Now, Daniel Brook, you also profile several of the entrepreneurs who began developing these stores and then expanded them into chains. I think James Eaton, Alan Jones. How did they get to create these huge chains in such a short period of time?
Well, the reason the industry exploded so quickly is that it was serving a growing market. In your introduction, you said that payday loans are targeted towards the poor, and I think it depends on how we define the poor. I would say they're targeted towards the lower middle class. I mean, anyone who takes out a payday loan has to have a bank account, which already gets rid of the unbanked, which is tens of millions of people, including 20% of Latinos and African Americans. So it's people who have jobs, but they're jobs that pay generally under $10 an hour and have inadequate benefits. So basically, this is a group of people that, as we know, is growing. The largest employer in the country, private employer in the country, is Walmart, and we know what their wages are like. So as this group of people who are living paycheck to paycheck, now 47% of Americans report living paycheck to paycheck. As this group has grown, the market for these predatory payday loans has grown as well.
Ginna Green, talk about how these payday loans affect different groups of people.
Absolutely. Thank you for having me. I wanted to also correct the introduction. You mentioned California possibly tackling payday loans this year, and it's not clear whether or how California will do that. We're using our report today that you mentioned to try and put forth the idea that California should, in fact, address payday loans. One of the key findings of our report that's coming out today, Predatory Profiling, the role of race and ethnicity in the location of payday lenders in California, is that in this state, payday lenders are 8 times more concentrated in African American and Latino neighborhoods than in white neighborhoods. And even after we account for factors like income, education, poverty rates, we find that they're still 2.4 times more concentrated in African American and Latino neighborhoods. I think this research has borne out what many people have thought we've known intuitively, that payday loans appear to really cluster in black and brown neighborhoods.
And does your report speculate on the reasons for that, of the companies that do concentrate in those neighborhoods?
You know, we've got the facts and the data to back up the claim, but we really can't get to the purpose or to the intent of payday lenders. Can we say that they're actually targeting African Americans and Latinos for a particular reason? No, and I would say that that's a really good question for a payday lender. What we do know is that in California borrowers lose $450 million a year just to pay payday loan fees. Of that amount, more than half, $247 million, comes from African American and Latino borrowers.
Daniel Brook, explain exactly how you take out a payday loan, the process of going into the store, and again, who started these stores and why they've grown into this, $40 billion industry.
Well, the process seems quite innocuous at first. I went into a check-into-cash store. This is the company I profile, which is the first of the major national payday lending firms. And you fill out a basic two-sided information sheet with your name, the name of your landlord or mortgage holder, 3 people in the community who know you well, your employer, and your spouse. And it takes, really a matter of minutes. You write your check and you get your cash. When this document sort of comes around to bite you is when and if you fall behind on payments. And at that point, all of these people start getting collection calls as well as you yourself who took out the loan. As I said, this was in check-into-cash, which was the first of the national payday lending chains. And it was founded by a man named Alan Jones, who I had the pleasure of interviewing at his headquarters in Cleveland, Tennessee. Mr. Jones is a rather fascinating character and quite taken with his own being a fascinating character. Essentially, Cleveland, Tennessee's culture has been hijacked by Jones. I went on Halloween when the local townspeople make a pilgrimage to the History Museum to look at the costume that Alan Jones created for his daughter's birthday many years ago. Then they go to the block party and concert that Alan Jones created to get the townspeople off of his lawn when he used to appear in costume as Tall Betsy, who he had named the official ghoul of Bradley County, Tennessee.
Daniel Brook, especially these chains, I would assume that they would need some investors or some capital to be able to expand rapidly and provide this cash to the working poor. Did you look into what were the financial institutions that were investing or behind these chains?
Yes, I did. Check-into-cash itself is a privately held company controlled by Alan Jones, but they told me when I went to company headquarters that they had a large line of credit from Wells Fargo Bank. Some of the other chains, including Advance America, which is the largest of the payday lending chains, are publicly traded on the stock exchange and are funded, have lines of credit from all the major banks in the United States, including Citigroup, JP Morgan, et cetera.
Daniel, you mentioned, you get calls if you don't pay back your loans, but could you go more into that, the frequency of these calls and the relationships that they develop?
Yeah, well, initially when you go into the store, they cultivate these sort of chummy customer relationships between the person behind the desk and the debtor. It's typical, and they're actually instructed in training to, ask about the person's family and their job and how they're doing. Of course, these relationships get more and more strained as the person gets more and more desperate and farther into debt.
I'd like to ask Ginna Green, in your report for the Center for Responsible Lending on the California situation, could you talk to us about what were some of the epicenters in California of this saturation of these lending institutions?
Absolutely. As you can imagine, Los Angeles, with approximately 313 PayDay stores in the city, was one, and a large proportion of African Americans and Latinos was one of the epicenters of this problem. We will have interactive PayDay maps as well as maps documenting this concentration on our website later today. What I wanted to note about what Daniel was just saying earlier about the debt trap and how the payday loans are a fundamental problem because they trap people in cycles of debt. One of the reasons why our policy recommendation for payday loans is a simple 36% rate cap that covers all small loans is because it's the only thing that works, and it's the only thing that will keep